Welcome to the Los Angeles Real Estate Roundup. Today is May 27th, 2024, and today we're talking about the unaffordability crisis in the Los Angeles real estate market. We start with culprit number one, mortgage rates. Now, I was very excited last week to be able to report that Mortgage News Daily had reported a mortgage rate that started with a 6. Specifically, we got down to 6.99% middle of last week on May 15th. However, since then, as you can see, rates have just gone up, and now mortgage rates are hanging out in the 7.16% range. This is a huge bummer, right? High rates means high home prices, but it's not that simple. If people didn't have enough money to buy homes at these high prices with these high rates, prices would drop. So it's not just that rates are high, it's that people are also able to afford homes with rates this high. Why is that? Well, a new report from Realtor.com sheds some light on that. Down payment share reaches Q1 high, but down payments fall from historical peak. And what's interesting in this article is their focus on California. Let me get to that area. Largest down payments in expensive California metros. The top 7 metros in terms of down payment amount are all in California. Let's take a look. Metros with the highest down payments in Q1 2024. At the top of the list, we have San Jose, then Santa Barbara, then San Francisco, then Oxnard, Ventura, and number 5 on the list, Los Angeles, our home market. And check this out. The average down payment in Los Angeles, 21.5%. And the median down payment amount in Los Angeles, $149,332. Now, this is a median. That means that half of the home buyers in Los Angeles who are taking a loan, because we're just talking about buyers who are taking a loan, which means they're putting in a down payment. We're not talking about cash buyers. Half of buyers who are buying with a loan are putting down more than $150,000 to purchase their home. And what's astounding is that because of the price increases and because rates remaining high, that number has grown 30% over the last year by $34,000. So a year ago, the median down payment was $34,000 less. That'd be about, $115,000? Now we're up to $150,000 being the median down payment for a home in Los Angeles. So look, we want to blame rates and say it's all rates, and as soon as rates fall, prices will come down. But the reality of the matter is that rates are high, but people have money to buy homes with rates this high. What we need for prices to really drop is for supply and demand to come back into a better balance. And there's been some very good analysis on that front, but before we get there, let's get into our local Los Angeles numbers for this week. And let's start with median sales price as reported by Redfin. This week, we came in at $908,000 for a median sale price of a home in Los Angeles. That's up slightly from last week's $904,000 and down just a hair from 2 weeks ago's $910,000. $910,000 is also where the median sale price landed in July of 2022 at the all-time pricing peak. Of course, until then, we hit that peak 2 weeks ago. Big question, are we going to surpass that peak this year? Or are we going to perhaps fall off for the rest of the year? Let's take a look at some more data to try to find out. Next up, we're going to look at homes sold. And to make the point I want to make, we're going to get rid of 2021 and 2022 so that we're looking just at 2023 and 2024, this year and last year. And as you can see, the number of homes sold per week in Los Angeles this year is running almost exactly where we were last year. This is really important when we start looking at how it relates to listings. When we look at new listings, and again, I'm isolating 2024 and 2023 here, we see that new listings have been up every week. That's this gap between these two lines. So if the same number of homes are being sold, but more homes are being listed every week, what should that mean for inventory this year? Now we're looking at active inventory, and again, I've just isolated the graph to this year and last year. Now we started this year at a huge deficit in terms of active listings. We were way below where we were last year. But since then, because we've been listing more properties every week, but selling approximately the same number of properties, active listings has climbed, and now we are 10.15% higher in active listings than we were this time last year. And this is exactly what we want to see. We want to see inventory rise so that prices can moderate. You know, if we got back to a supply and demand balance like we had in 2019, we might be in a good place. 2019 was a seller's market. Prices did climb in 2019. It was the last normal year before the pandemic really sent the housing market into a tizzy, one might say. But if we can get back to the 2019 supply and demand balance, maybe we have a shot at prices moderating. Can we do that? According to housing analyst Bill McBride in his fantastic Substack, Calculated Risk, we might get back to 2019 levels. In a very recent posting called Watch Months of Supply, he provided this really awesome chart. And to explain it to you, first, I'm just going to get rid of these red numbers. We'll bring those back in a second. So we have a couple columns here. On the left is sales, and we're comparing 2019 to 2024. Now, in 2019, in January, we had 4.9 million sales. This is annualizing the month's number of sales to come up with an annual rate. We had a pretty traditional peak in August of 5.4 million. And then actually 2019 was a little unusual in that the number of sales peaked again in December at 5.5 million. Usually sales are down in December. Usually the peak is in the summer months. But what can I say? That's what happened. Now, looking at 2024, in January, we had 4 million sales, up to 4.3, back down to 4.2, and then back down to 4.1. So as you can see, this year, 2024, sales are much lower than in 2019. Next up, let's look at inventory numbers. And again, Bill compares 2019 to 2024. In 2019, inventory, again, annualized, started the year at 1.5 million homes for sale, peaked in June at 1.92 million homes for sale, and then fell back down in December to 1.39 million homes for sale. And if we look at 2024 so far, we see that we started the year with just over 1 million homes for sale, and now in April, we've grown to 1.2 million homes for sale. So we have a story of much less inventory, less sales and less inventory. So we get to this months of supply column. And again, we compare 2019 to 2024. In 2019, we started the year at 3.8 months of supply, grew to 4.3 months of supply in June, and then fell back down to 3 months of supply in December. In 2024, we started the year at 3 months of supply and have so far grown to 3.5 months supply. And so the question is it possible this year to get to where we were in 2019, a month's supply number in, around 4, in the low 4s, or at least in the high 3s? To answer that question, Bill introduces some hypothetical numbers, which we have in red. So in the sales column, these red numbers represent if 2024 sales continue at 2023 sales levels. Now, you saw on the graph, 2024 and 2023 are tracking each other very closely. So these numbers are very likely to come about. In the months supply column, Bill puts 2019's months of supply numbers into 2024. So, these are target numbers for us. 4.3 months supply next month, 4.3 months supply the month after that, then 4.2, then 4.0. Those are the targets. And in the inventory column, these red numbers, Bill has computed how much inventory we would need based on the sales that we can project looking at 2023. How much inventory would we need to reach these months of supply numbers? Well, nationally, we would need to have 1.5 million homes for sale in May, 1.473 million homes for sale in June, 1.4 in July, 1.343 million homes for sale in August. Bill says, the answer is, if sales continue to track last year, NAR reported inventory would have to increase to around 1.4 million by July for months of supply to match 2019 levels. That would be a 15% increase from the April levels. So we need inventory to increase 15% from where it is now, which is not a lot, for us to get back to 2019 levels. We'll be keeping an eye on inventory numbers in the coming weeks and months. Subscribe and hit that bell icon so you don't miss next week's update.